Navigating taxes in retirement can be daunting, and it's easy to feel overwhelmed by the complexities. The tax landscape is ever-changing, with new regulations and adjustments coming into effect each year. But understanding the latest IRS updates is key to keeping more of your money. Staying informed empowers you to make sound financial decisions and minimize your tax burden. This guide breaks down the 2025 tax brackets for seniors, providing a clear and concise overview of the different income levels and corresponding tax rates. Focusing on what matters most for your unique income sources, because every retiree's financial situation is different, and your tax strategy should reflect that. Social Security, a cornerstone of retirement income. Pensions and retirement accounts, all of which have specific tax implications that you need to be aware of. With inflation-adjusted brackets and deductions, understanding these adjustments is crucial for accurate tax planning. Knowing the new numbers helps you plan smarter and make informed decisions about your finances throughout the year. And avoid overpaying, ensuring you keep more of your hard-earned money in your pocket. We'll explain tax brackets, demystifying how they work and how they affect your tax liability. How Social Security is taxed, clarifying the rules surrounding the taxation of your benefits, and the benefits of the standard deduction for seniors, highlighting how this can simplify your tax return and reduce your taxable income. Our goal is to empower you with the knowledge and tools you need to navigate the tax system with confidence. Give you a clear, step-by-step roadmap guiding you through the essential aspects of senior tax planning, so you can approach tax season with confidence, knowing you're well prepared and in control of your finances. By learning the basics now, you're setting yourself up for a smoother and more financially secure future. You can make strategic decisions all year, optimizing your income and deductions to minimize your tax liability. Like how much to withdraw from your retirement accounts, carefully considering the tax implications of each withdrawal, without bumping into a higher tax rate. Strategic planning can help you avoid unnecessary tax burdens. Let's start with the essentials of the U.S. tax system, providing a foundational understanding of how it works, and build your foundation for a successful 2025 tax season. With the right knowledge, you can navigate the tax landscape with confidence. Ready? Let's dive in. We'll break down complex topics into easy-to-understand concepts. Let's clarify tax brackets. It's a term we hear often, but understanding what it truly means can make a significant difference in your financial planning, especially as you approach or navigate retirement. In the U.S., your income is taxed in segments according to a progressive system. This means that different portions of your income are subject to different tax rates, not all at one rate. This is a crucial point to grasp, as it directly impacts how much you ultimately pay in taxes. The first portion of your income is taxed at the lowest rate, providing some initial relief. This lower rate applies up to a certain income threshold, and only the income above each threshold moves into the next bracket. It's like climbing a staircase where each step represents a different tax rate. For example, if you're in the 22% bracket, it doesn't mean all of your income is taxed at that rate. Only the income within that range is taxed at 22%, the portion that falls specifically within that bracket's income limits. The rest is taxed at lower rates. This tiered system ensures that you're not penalized excessively for earning slightly more. This progressive system means a small increase in income won't trigger a huge tax jump. It provides a smoother transition between tax liabilities. Your marginal tax rate is what you pay on your last dollar earned, representing the tax rate of your highest income bracket. While your effective tax rate is the average rate you pay overall, this is calculated by dividing your total tax liability by your total income. For seniors, understanding this nuanced system helps you plan withdrawals from retirement accounts strategically and avoid unnecessary tax spikes. Careful planning can make a significant difference in your after-tax income. A large one-time withdrawal could push part of your income into a higher bracket, potentially increasing your overall tax burden. So spreading distributions over several years can help. This approach can keep your income within lower tax brackets. Knowing how brackets work turns you into an active manager of your retirement finances, empowering you to make informed decisions. With this knowledge, you can keep more of your savings, ensuring a more comfortable and secure retirement. Now let's look at the actual 2025 tax brackets for seniors, providing you with the specific numbers you need to plan effectively. As we look ahead to 2025, it's crucial for seniors to understand the upcoming changes to the federal income tax brackets. The IRS makes annual adjustments to these brackets to keep up with inflation, ensuring that tax burdens don't unfairly increase due to rising prices. These adjustments are designed to reflect the real-world economic conditions that seniors face. For single filers, the first £11,775 of taxable income is taxed at 10%. This is the lowest tax rate, applying to the initial portion of income. The next bracket taxes income up to £47,900 at 12%. This means any income earned between £11,776 and £47,900 will be taxed at this rate. Income exceeding that up to £102,050 is then taxed at 22%. Understanding these thresholds is key to estimating your tax liability. Most retirees, depending on their income sources, will likely find themselves falling within these lower to middle brackets. Careful planning can help manage which bracket you land in. Married couples filing jointly benefit from significantly wider tax brackets, effectively doubling the income thresholds compared to single filers. For these couples, the 10% tax rate applies to income up to £23,550, providing a larger window for lower taxed income. The 12% bracket extends up to £95,800 for married couples filing jointly, offering substantial tax relief for middle-income earners. And the 22% rate applies to income up to £204,100, allowing for a considerable amount of income to be taxed at this moderate rate. These wider brackets are a significant advantage, allowing married couples to earn more income before moving into the higher tax brackets, potentially saving them thousands of pounds in taxes. Remember, all these figures refer to taxable income, that is, your income after all eligible deductions have been subtracted. To effectively plan your taxes, start by estimating your total taxable income for the year, including all sources of revenue. This includes income from pensions, which are a common source of income for retirees. Don't forget to account for any retirement account withdrawals you anticipate making. If you're engaged in part-time work, include those earnings as well. Investment income, such as dividends and capital gains, also needs to be factored in. And remember that a portion of your Social Security benefits may also be taxable. Once you have a good estimate of your taxable income, use the provided bracket tables to calculate your potential tax bill. Consider adjusting your retirement withdrawals or other income sources to strategically stay within a lower tax bracket if possible. Taking this proactive approach to managing your income can significantly minimize your overall tax burden and maximize your retirement savings. Understanding which tax bracket you fall into is the crucial first step towards implementing a smart and effective tax planning strategy. Next, we'll explore how taking advantage of the standard deduction, which is also adjusted annually, can further help to lower your taxable income and reduce your overall tax liability. Before applying tax brackets, subtract deductions from your income. Most seniors use the standard deduction. For 2025, the standard deduction is £14,850 for singles and £29,700 for married couples filing jointly. If you're 65 or older, you get an extra deduction. £1,950 for singles, £1,600 per spouse for couples. That means a single senior gets £16,800 and a married couple where both are over 65 gets £32,900. This shields more of your income from tax and can even eliminate your liability if your income is below the threshold. Most seniors benefit more from the standard deduction than itemizing, thanks to these higher amounts. Always compare, but for most, the standard deduction is the clear winner. It's a simple way to lower your tax bill. Now let's see how this works in practice. Let's walk through a quick example. Mary, age 70, has £50,000 in pension and IRA income. She gets a £16,800 standard deduction, leaving £33,200 taxable. The first £11,775 is taxed at 10%, £1,177.50. The rest at 12%, £2,571. Total tax, £3,748.50. Her effective tax rate is just under 7.5%, much lower than her top bracket. For a married couple, John and Jane, both 72, with £85,000 income, their standard deduction is £32,900, leaving £52,100 taxable. The first £23,550 is taxed at 10%, £2,355, the rest at 12%, £3,426. Total tax, £5,781. These examples show how the progressive system and standard deduction work together to lower your tax bill. Breaking it down makes tax planning manageable. With the basics covered, let's talk about Social Security taxation. Understanding this can help you keep more of your benefits. Here's how it works. Whether your Social Security is taxed depends on your combined income, your adjusted gross income, non-taxable interest, plus half your Social Security. For singles, if combined income is between £25,000 and £34,000, up to 50% of benefits may be taxable. Above £34,000, up to 85% may be taxable. For married couples, the thresholds are £32,000 and £44,000. Below these amounts, your benefits aren't taxed. Only the portion of benefits is added to your taxable income, not taxed at those rates. Example: a single filer with £22,000 income and £14,000 Social Security has combined income of £29,000, so up to 50% of her benefits are taxable. Managing other income sources can help keep more of your Social Security tax-free. Next, let's look at how other retirement income is taxed. Most retirees have income from pensions, traditional IRAs, 401, KKs, Roth accounts and investments. Pensions and traditional IRA, 401(k) withdrawals are taxed as ordinary income at your marginal rate. Roth IRA and Roth 401(k) withdrawals are tax-free if you're over 59.5 and the account is at least 5 years old. This makes Roth accounts a powerful tool for tax-free retirement income. Investment income is taxed as capital gains. Long-term gains get lower rates, 0%, 15%, or 20% depending on your income. Short-term gains are taxed as ordinary income. A mix of account types gives you flexibility to manage your tax bill each year. Now let's explore strategies to lower your taxes. Here are some ways to cut your tax bill. Manage withdrawals from taxable and tax-free accounts to control your taxable income and avoid higher brackets. Use qualified charitable distributions or QCDs from your IRA. If you're 70.5 or older, these count toward your required minimum distribution and aren't included in your income. Look for tax credits, like the credit for the elderly or disabled, which directly reduce your tax bill. Consider tax loss harvesting in investment accounts. Sell losing investments to offset gains, or up to £3,000 of ordinary income. These strategies can make a big difference, especially when combined. Always consult a tax professional to tailor these moves to your situation. Let's wrap up with the key takeaways. Here's what to remember for 2025. Tax brackets are progressive. Your income is taxed in layers, not at a flat rate. The standard deduction, especially the extra for seniors, is a powerful way to lower your taxable income. Social Security taxation depends on your combined income, so manage other income sources carefully. Withdrawals from traditional accounts are taxable. Roth withdrawals are tax-free. Strategic planning like using QCDs, tax credits, and tax loss harvesting can further reduce your bill. Start planning early, not just at tax time. Knowledge is your best tool for keeping more of your retirement income. With these tips, you can approach tax season with confidence and peace of mind.